In every major market collapse of the past century, before the headlines, before the blood-red charts, before policymakers scramble to reassure the public that everything is contained, there is a moment. It's a quiet, invisible moment when the system takes its first step toward failure. It never looks dramatic. It never announces itself. It's small, almost forgettable, like the sound of a hinge shifting inside an old vault door. Yet it is always there, repeating across generations, across regimes, across asset classes, forming a pattern so consistent it terrifies the few who have learned to recognize it. This pattern does not live on the screens that traders stare at. It does not appear in mainstream explanations of why crises happen. It hides in the micro-fractures of liquidity, in the subtle misalignments of incentives, in the structural pressures that compound long before anyone notices. And if you listen closely to the rhythm of global markets, you can hear it. It's the three-stage trigger that emerges long before panic becomes public. Most people believe crises start with some dramatic catalyst. A bankruptcy, a sudden rate hike, a geopolitical shock, a failed auction, a sudden plunge in asset prices. But that is only the surface eruption, the final stage of something that has already been unfolding in silence for weeks or even months. The real beginning is buried deeper, in the very architecture of the system itself. Before markets fall, they shift. Before liquidity evaporates, it thins. Before fear erupts, confidence cracks quietly in places most investors never think to look. And behind those shifts is a mechanism that has repeated so many times it feels less like chance and more like a law of nature. It's a sequence of tension, fracture, and cascade that turns a small structural misalignment into a full-blown systemic event. You may have felt this pattern before without even knowing it. Maybe during 2008, when the obscure funding markets started tightening weeks before Lehman Brothers collapsed, even while official narratives insisted everything was stable. Maybe in early 2020, when Treasury market liquidity, the bedrock of the global financial system, dried up well before the pandemic shutdowns forced policymakers into emergency action. Or perhaps in 2022, when currency markets convulsed long before central banks openly admitted they were losing control of price stability. These moments were not random. They were the early stages of the same architecture at work. The quiet shift, the hidden crack, and the inevitable cascade. Tonight, we step into that architecture, not to relive history, but to expose the systemic logic running beneath it. This is the logic that determines who breaks first, why contagion spreads the way it does, and why every crisis, no matter how different on the surface, follows the same underlying choreography. You are never supposed to see this pattern. And once you understand how this three-stage trigger works, you will never look at markets the same way again. So, what is this three-stage trigger? Let's break it down. Stage 1 isn't a market event at all. It's what I call incentive divergence. This is where the goals of different players in the financial system start to pull apart. Think of it like this. For a system to be stable, everyone needs to be pulling in roughly the same direction. Banks want to lend, borrowers want to borrow, and investors want to provide capital, all under a shared understanding of risk and reward. But in the lead-up to a crisis, this alignment breaks down. A classic example is when regulators, in an attempt to make the system safer, introduce a new rule. This rule might inadvertently create a loophole that incentivizes a specific type of financial institution to take on a hidden, concentrated risk that no one else sees. For instance, after 2008, new regulations made it expensive for big banks to hold large inventories of bonds. This was meant to reduce their risk, but it created a vacuum. Who stepped in? Highly leveraged hedge funds and specialized trading firms. Their incentive was to profit from the small price differences the big banks no longer could. They became the new market makers, providing essential liquidity. But their incentive wasn't stability. It was short-term profit, using immense leverage. The system appeared to be working, but the incentives had diverged. The banks were incentivized for safety, while the new players were incentivized for leveraged risk-taking. This creates a silent tension, a coiled spring in the heart of the market. Everyone is acting rationally based on their own goals, but collectively, they are creating a fragile structure. This is stage one. It's invisible, it's silent, and it sets the stage for everything that follows. This brings us to stage two, liquidity thinning. Once the incentives have diverged, the market structure has fundamentally changed. On the surface, everything might still look fine. Bid-ask spreads are tight, trading volumes are high. But beneath the surface, the quality of liquidity has become poor. What does that mean? It means the market can handle normal, everyday trading flows, but it can no longer absorb a shock. It's like the difference between a deep ocean and a shallow pond. Both are wet, but only one can handle a storm. In the years before a crisis, liquidity becomes increasingly concentrated in the hands of a few highly leveraged players who are all making the same bet. Because their incentives are aligned for profit, not stability, they provide liquidity when times are good. But the moment a small shock hits a surprising inflation print, a minor political event, their risk models all flash red at the same time. They are incentivized to pull back simultaneously. This is the thinning. Before the price even drops, the market's ability to absorb selling pressure vanishes. You see this in the order book. Suddenly, the deep bids to buy disappear. The market becomes hollow. It's not that everyone is selling yet. It's that no one is willing to buy in size anymore. This is the crucial moment that happens before the panic. The system has lost its shock absorbers. A small sale that would have been easily absorbed a month ago now causes a disproportionate price drop. This is the fracture. The structural weakness created in stage one has now become an active vulnerability. The market is primed to break. And that leads directly to stage three, the cascade. This is the part everyone recognizes as the crisis. With liquidity gone, the first forced seller appears. This could be anyone, a fund facing a margin call, a company needing to raise cash, a bank needing to meet regulatory requirements. Because the market is now incredibly thin, their sale, even if it's not massive, drives prices down sharply. This price drop triggers more margin calls for other leveraged players who are making the same bet. They are now also forced to sell. This is no longer a choice. It's a forced deleveraging. Selling begets lower prices, which begets more selling. The cascade has begun. The fear is no longer about fundamentals. It's about survival. It's a race to sell before everyone else does into a market with no buyers. This is when you see those terrifying chart drops, the air pockets where the price just collapses. The contagion spreads through mechanical linkages, not just sentiment. A hedge fund blows up, forcing its prime broker to sell the collateral, which hits the price of assets held by other funds, triggering their margin calls. It's a domino effect that was programmed into the system back in stage one. The initial catalyst for the first sale is almost irrelevant. It could have been anything. The real cause was the fragile structure built on divergent incentives and the subsequent thinning of liquidity. The crash is just the logical, mathematical conclusion of the first two stages. Let's apply this framework to the 2008 crisis. Stage 1, Incentive Divergence. Banks were incentivized to create and sell mortgage-backed securities to get them off their balance sheets, while ratings agencies were incentivized to give them A ratings to win business. Investors were incentivized to buy these safe, high-yield assets. Everyone was pursuing their own rational goal, creating a mountain of hidden risk. Stage 2, Liquidity Thinning. The market for these complex securities was entirely dependent on the banks that created them. When the first signs of trouble appeared in the subprime market, these banks, knowing the true quality of the assets, were the first to stop providing liquidity. The market for these bonds became hollow instantly. Stage 3, the cascade. Once Bear Stearns faced its funding crisis, it had to start selling assets into this illiquid market. The price drops triggered margin calls across the system, leading to the forced liquidations that brought down Lehman and AIG. It was a perfect, textbook example of the three-stage trigger. So why is this so important to understand now? Because this pattern is not a relic of history. It's happening again in different markets with different players. The core principles remain the same. The global financial system is more complex and interconnected than ever. The incentives driving central banks, governments, commercial banks, and shadow banks are diverging in new and unpredictable ways. Liquidity in key markets, from government bonds to currencies, has shown signs of thinning repeatedly in recent years. We are seeing the warning signs of Stage 1 and Stage 2 all around us if we know where to look. The mainstream narrative will only alert you when we are well into Stage 3. By then, it's too late. The most important part of this mechanism is not how crises begin, but why they never begin where the world expects them to. From the very beginning of modern finance, long before glowing screens and high-speed algorithms turned markets into a blur of microsecond signals, crises have followed a pattern. It's a pattern so persistent, so predictable, that you can trace it like a scar across the last 120 years of economic history. To see this pattern, this architecture of collapse, you have to go back to the systems that defined the first global monetary order, the gold standard, at the turn of the 20th century. Back then, liquidity was brutally simple and unforgivingly scarce. In 1907, the United States was hit by a panic that seemed to appear out of nowhere. We saw bank runs, collapsing trust companies, and interest rates spiking to unbelievable levels in just a few days. The newspapers blamed speculators and greedy bankers. But buried deep in congressional reports years later was a quieter truth. The crisis had actually begun weeks earlier, when the primary source of leverage for the entire financial system started to thin out in a way only insiders noticed. The system didn't break all at once. First, it shifted. Then, it fractured. And only in the final days did it cascade into a system-wide convulsion so violent it forced the creation of the Federal Reserve. That three-step rhythm, the shift, the fracture, the cascade, became the template for everything that followed. When the Fed was created in 1913, policymakers believed they had finally built a machine that could tame financial instability. But you can't erase a system's foundations. The world still relied on fragile cross-border capital flows and a rigid gold standard that amplified every shock. Think about the Great Depression. The famous stock market crash of 1929 didn't just happen in October. The real beginning was months earlier. The hidden shift occurred when credit conditions tightened, when brokers' loans stopped expanding, and when international gold flows signaled deep strain. The fracture emerged as banks started calling in loans and hoarding cash. And only after these invisible tensions snapped together did the cascade arrive, pulling industry, employment, and global trade into a downward spiral that lasted a decade. Economists wrote thousands of pages about the Depression, but this silent choreography that preceded it, that three-stage sequence, was largely ignored. It didn't fit the neat narrative. Then came 1966 and 1969, two often forgotten credit crunches. They were dismissed as temporary distortions in the bond market. But archived Federal Reserve transcripts tell a different story. Banks had been quietly rationing credit for months. Again, the sequence held. Subtle shifts in liquidity conditions appeared first, fractures in institutional balance sheets emerged second, and only then did the public see the cascade in falling bond prices and rising yields. The 1970s brought their own version of the pattern. The breakdown of the Bretton Woods system in 1971 is remembered as a political decision by President Nixon, but it was preceded by months of aggressive gold outflows and speculative pressure on the dollar. The shift occurred in foreign exchange data. The fracture appeared in dwindling reserves, and the cascade came when the gold window was officially closed. Shortly after, the 1973 oil shock followed the same architecture. The shift began with subtle tensions in energy financing. The fracture emerged as petrodollars destabilized global money, and the cascade hit when inflation exploded. Let's fast forward to 1987, Black Monday, one of the sharpest one-day market drops in history. But its roots stretch back into the summer months. Portfolio insurance strategies began distorting the market. Dealers noticed thin liquidity. These were the early signals of the shift. By October, volatility had begun to fracture the system. Spreads widened, market makers backed away, and hedging algorithms entered a self-reinforcing death spiral. Only then did the cascade arrive, wiping out over 20% of market value in a single day. Policymakers called it a bizarre anomaly, but its architecture mirrored every crisis that came before it. Then came 1994, the so-called bond massacre. Everyone blames the Fed's rapid rate hikes, but that ignores the imbalances quietly building beforehand. Yield curves flattened, mortgage hedging intensified. These were classic shift stage signals. As the Fed tightened, the fracture became visible. Leveraged bond funds suffered massive losses, and liquidity evaporated. Only after these fractures converged did the cascade hit, sending yields soaring and destabilizing global bond markets. The pattern held. Again, the late 90s delivered another spectacular demonstration with the collapse of long-term capital management in 1998. The dramatic headlines of a Wall Street bailout told only the final part of the story. The shift had been visible months earlier in widening spreads on government debt. The fracture appeared when funding markets tightened and LTCM's massive leverage began to crush it. Only at the very end did the cascade hit, threatening a systemic event that forced a coordinated rescue. Then came the dot-com bust. We remember the story of overvaluation and irrational exuberance, but look closer and you see the familiar rhythm. The shift occurred in declining profit margins and tightening venture funding. The fracture emerged when corporate bond markets began demanding higher pay for taking on risk. And the cascade struck when credit dried up, dragging equity valuations down with it. The mechanism repeated itself, just in a different asset class. The architecture was identical. The 2008 global financial crisis is the purest modern expression of this three-stage trigger. The visible crisis began with Lehman Brothers, but the real beginning stretched all the way back into 2006 and 2007. The shift appeared in the mortgage market, rising delinquencies and cracks in subprime securities. The fracture emerged when credit markets inverted, when repo markets demanded higher collateral, and when banks began hoarding cash. Only at the end, after these fractures converged, did the cascade seize global finance, destroying household wealth across the world. The system cracked exactly where the architecture predicted it would. Even the 2020 crash, which many believe was a unique pandemic-driven event, followed the same structure. Before lockdowns, before the world even recognized the threat, the world's safest market, U.S. Treasuries, began showing strange signs of stress. Spreads widened. Dealers refused to make markets. These were shift stage signals. The fracture came when hedge funds unwound huge trades and liquidity vanished. The cascade hit only after these fractures aligned, triggering one of the fastest collapses in financial history. Most recently, in 2022, as inflation surged and central banks scrambled, the same pattern unfolded in currency and government bond markets. The shift appeared in foreign exchange distortions. The fracture emerged when the UK bond market broke under the weight of leveraged pension funds. And the cascade arrived when policymakers were forced into emergency interventions, proving once again that the three-stage trigger was still the dominant architecture of global finance. Across every decade, across every monetary system, from the gold standard to the dollar-dominated world of today, this architecture persists. It doesn't depend on technology, politics, or what story we tell ourselves. It depends on structural incentives, on how liquidity moves, and on the inherent fragility of interconnected leverage. This pattern is not a coincidence. It is a blueprint. And once you see it repeated across more than a century of financial history, you can no longer dismiss it as random. There's a dangerous pattern that repeats throughout history, a kind of three-stage crisis trigger. What makes it so insidious is that it doesn't just repeat, it evolves. The moment you think policymakers have finally built a wall high enough to contain it, the crisis mechanism mutates and finds a new crack to slip through. This is the twist that most people never see coming. The system learns from each disaster, but the trigger survives by shifting to a part of the financial architecture that no one is watching. Let's take a quick walk through history. In 1907, the weak point was something called collateralized call money. Fast forward to the Great Crash of 1929, and the culprit was broker credit. In 1987, it was portfolio insurance. In 2008, it was the complex world of securitized mortgage leverage. And more recently, in 2020, the vulnerability was found in the very bedrock of the global financial system, the Treasury market. After each of these events, policymakers scrambled to build defenses. They introduced new regulations, beefed up liquidity buffers, created stress tests, implemented circuit breakers, and established new forms of oversight. All of these measures were designed with one goal: to prevent the last disaster from ever happening again. And for a while, it always seems to work. The surface of the market calms down. The instruments that blew up last time look stable. The public is reassured that the system is now safer, more resilient, and more carefully managed than ever before. But here's the crucial part. Beneath that calm surface, the pressure that used to build up in the old, now regulated channels doesn't just disappear. It migrates. It flows into new, less regulated, or simply less understood channels, where it begins to form the exact same dangerous sequence all over again. A subtle shift in the market leading to a sudden fracture, which then triggers a catastrophic cascade. The crisis trigger wasn't eliminated, it just relocated. And this is where things get truly unsettling. Our modern financial system, with all its incredible technology, complex regulations, and powerful central banks, is actually more vulnerable to this relocation than older, simpler systems ever were. In the past, market fractures formed slowly because information and money moved slowly. It took months, sometimes years, for dangerous levels of leverage to build up. There was time to see the cracks forming. Today, the entire global financial landscape operates on a knife's edge. Small imbalances don't just stay small. They ripple outward with unprecedented speed. Interconnected markets react to one another in milliseconds. Funding spreads, which measure the stress in the system's plumbing, can widen in a matter of hours, not weeks. Sophisticated algorithmic trading strategies can spot and amplify tiny mispricings before most human traders even have their morning coffee. What does this mean? A structural shift that might have taken an entire season to develop back in the 1930s can now unfold over a single trading session. This incredible speed hides the first stage of the crisis trigger, the initial shift, so effectively that by the time policymakers or the public become aware of it, the system has already moved into the second stage, the fracture. By then, it's often too late. The dominoes are already falling. This leads us to the defining twist of the modern era. The trigger no longer needs a massive, obvious imbalance to set off the chain reaction. In previous decades, crises usually started with something you could see from a mile away: a speculative mania, a massive credit boom, or an obvious real estate bubble. Think of the dot-com bubble or the housing bubble before 2008. The excesses were plain to see. Today, the financial architecture is so tightly woven together, so intricately coupled, that even a modest, almost invisible imbalance can act as the hinge that swings the door wide open to a crisis. A slight deviation in Treasury futures positioning, a subtle loss of depth in a key market-making operation, a temporary funding squeeze in an obscure offshore dollar market. These are what we can call micro-shifts. They're almost invisible to anyone outside the institutional core of the financial system. Yet, any one of them can become the first step in that familiar three-stage pattern. This is precisely why modern crises feel so sudden and shocking, even though, structurally, they've been building for some time. The surface of the market remains perfectly calm, right up until the moment the system flips into fracture mode. By that point, the hidden mechanisms reinforcing the imbalance are already locked in and accelerating. So what is it that the insiders, the people who operate at the heart of this system, truly fear? It's not the cascade stage, that as the part everyone sees on the news when the market is in freefall. What they genuinely fear is that chilling moment of recognition. The moment they spot the initial shift happening in a place where the system has no tools, no playbook, and no way to respond effectively. In 2020, that place was the U.S. Treasury market, the market that everyone, including policymakers, assumed was the safest and most liquid in the world. It was considered unbreakable, and yet it broke. In 2022, it was the UK gilt market, the British equivalent of the Treasury market. Leverage had quietly and invisibly accumulated in pension funds, until the entire structure buckled under pressure from a small political shock. In both of these very recent cases, the early warning signals appeared in markets that were considered safe, boring, or perfectly liquid. This is the great paradox of the contemporary crisis architecture. The weak point is now more likely to appear precisely where we take resilience for granted. Think about it. When a system relies too heavily on the assumption that a particular asset, like a government bond or a particular institution, can never fail, that very assumption becomes the perfect hiding place for the initial imbalance to grow. It's the one place nobody is looking for trouble. And this brings us to the part that officials will rarely, if ever, explain openly. The greatest vulnerability in any highly connected, complex financial system is not in the sectors known for risk. It's not in junk bonds or speculative tech stocks or volatile emerging markets. Everyone expects trouble there, and the system has shock absorbers ready. No, the greatest vulnerability lies in the sectors assumed to be completely immune to risk. When stress begins in the expected places, the architecture can usually handle it. But when the initial shift begins in the system's very backbone, in sovereign bonds and core funding channels, in the institutional hedging frameworks that are supposed to provide safety, the three-stage trigger activates with a force that no computer model or risk dashboard can possibly foresee. So here is the final, crucial twist. Crises are not born in the dark, shadowy corners of the market because those corners are inherently dangerous. They are born there because the bright, polished, seemingly safe surface of the system distracts everyone from noticing that first, quiet, fatal movement happening just beneath. So, what if I told you that every major financial crisis, from 2008 to the most recent market meltdowns, doesn't just happen? They aren't triggered by a single explosive event. Instead, they follow a predictable, three-stage pattern, a sequence so subtle in its early phases that it is almost always missed until it is far too late. Understanding this sequence is the key to seeing what is really happening beneath the surface of the global economy. Forget the idea that crises erupt out of nowhere. The truth is, they are systemic responses to deep, structural pressures that build up slowly like cracks forming in a foundation. This all begins with what we call the shift stage. This is where the first almost invisible misalignments appear in the core plumbing of the financial system. Think of it like this. Markets that are usually smooth and predictable start to show tiny glitches. These aren't front-page news. We're talking about small deviations in benchmark spreads, unusual movements in the yields of supposedly safe assets, or a thinning of order books in critical markets. For example, publicly available data from the Bank for International Settlements, or BIS, showed that in early 2020, bid-ask spreads in certain U.S. Treasuries widened significantly well before anyone was talking about official interventions. This was a microfracture, a tiny signal that liquidity was getting tight. Similarly, if you look at Federal Reserve data from the period before the 2008 crisis, you can see that key funding rates started to diverge from their normal patterns long before major banks were in trouble. These signals are quiet. They're often dismissed as market noise, something only specialists would notice. But in today's markets, where liquidity depends on algorithms, market makers, and complex financial engineering, these small shifts are the first sign that the system's equilibrium is starting to tilt. As this shift progresses, incentives begin to change. Dealers might reduce their inventory to manage risk. Hedge funds adjust their strategies as their models detect strange volatility. Banks change how they source U.S. dollars when currency swap rates drift out of line. The IMF's Global Financial Stability Reports have repeatedly shown how even minor fluctuations in these funding markets can predict financial stress months in advance. The shift stage isn't about visible stress. It's about the quiet withdrawal of balance sheet capacity, the very lifeblood of global finance. During this phase, the system becomes incredibly sensitive, like dry kindling waiting for a spark. The shift itself doesn't cause the crisis, but it sets the stage perfectly for what comes next: the fracture. The fracture stage is when those initial subtle imbalances harden into real stress points that the market can no longer fix on its own. The key difference here is that the system stops behaving rationally. In the shift stage, markets were still moving in familiar patterns. In the fracture stage, they start to move in ways that defy all logic and conventional models. This is when the architecture exhibits nonlinear responses, sudden, unpredictable movements. For instance, during the long-term capital management crisis in 1998, swap spreads widened dramatically in ways that had nothing to do with economic fundamentals. It was a breakdown in the arbitrage channels that are supposed to keep markets efficient. In 2007, an index linked to subprime mortgages inverted against safer credit benchmarks, revealing a deep fracture inside the credit creation machine. And more recently, in 2022, UK government bond yields surged far beyond what any inflation model could explain. Why? Because pension funds using complex investment strategies were forced to sell assets, creating a vicious feedback loop. These fractures happen when balance sheets become too constrained, when hidden leverage starts to unwind, or when the institutions that are supposed to absorb risk all step back at the same time. Reports from the U.S. Treasury's advisory committees have shown how even a small reduction in dealer activity can massively amplify volatility. This is the moment the system goes from being flexible to brittle. And this is where dangerous feedback loops begin. A liquidity shortage forces institutions to hedge their positions. Those hedges push prices down further. Falling prices trigger margin calls, and margin calls force even more selling. The process becomes a self-reinforcing downward spiral. In markets like U.S. Treasuries, which are supposed to be the safest in the world, we saw this happen within hours in March 2020. Market depth just evaporated. But fractures aren't just about prices. They can appear in funding channels where the cost of borrowing dollars offshore can spike even when everything looks calm domestically. They can also appear in behavior as money market funds flee to safety or banks pull back from lending. The common thread is that the system is losing its internal shock absorbers. To the public, everything might still look fine. But beneath the surface, the entire structure is reorganizing around these stress points, preparing for the final, irreversible phase, the cascade. The cascade is the moment of synchronization. It's when the entire system locks together and moves as one. In normal times, different markets and institutions act independently. Shocks are contained and absorbed locally. But during a cascade, correlations spike across everything: stocks, bonds, commodities, currencies. It all moves together, usually down. Data from the IMF and global central banks shows this clearly in every major crisis. In 2008, strategies designed to diversify risk suddenly amplified it because all assets started falling at once. In 2020, Treasury volatility, stock market volatility, and credit risk all moved in perfect, terrifying unison. The cascade is defined by forced behavior. Institutions are no longer making decisions based on long-term value. They're acting out of pure survival instinct. The collapse becomes mechanical and predictable. Fire sales of assets accelerate price declines. Funding dries up completely, except from the last resort, central banks. The collateral that underpins the entire system becomes either too scarce or is no longer trusted. The system enters a state where every defensive action by one institution triggers another crisis for someone else. What's truly frightening about modern cascades is their speed. Federal Reserve transcripts show that the amount of liquidity support needed in March 2020 grew to historic levels within days because the system was collapsing faster than ever before. Market data showed that liquidity in the Treasury market, the bedrock of global finance, had vanished. BIS data confirmed that U.S. dollar funding stress had spread across the globe almost instantly. This is the signature of a full-blown cascade: rapid deleveraging, synchronized stress, and institutional retreat. But here's the most important takeaway. The real danger of the cascade isn't just its speed or its violence. It's the fact that once the fracture stage becomes entrenched, the cascade is almost inevitable. The modern financial architecture, with its interconnectedness and leverage, leaves very little room for a spontaneous recovery. You often hear about central banks saving the day, but the historical record is clear. They are only able to intervene after the system has already entered its terminal phase. In 2008, interventions came after the interbank market had already frozen. In 2020, they came after the Treasury market broke. In 2022, the Bank of England stepped in only after pension funds were on the brink of collapse. Policymakers react to cascades. They don't prevent them. True prevention would have to happen during the early shift or fracture stages. But this rarely happens. The signals are too subtle, too fragmented, and spread across too many different parts of the system. By the time everyone agrees there's a problem, the sequence is already locked in and the cascade is well on its way. To understand why today's markets are so fragile, we need to look under the hood at their fundamental structure. The first major culprit is what I call embedded leverage. This isn't just about borrowing money. It's leverage hidden deep inside derivatives, structured products, and complex institutional strategies. The Bank for International Settlements, or BIS, reports that the notional value of derivatives, especially for interest rates, has soared into the hundreds of trillions. These aren't just numbers on a screen. They represent massive, interconnected hedging operations. When interest rates make a sharp move, these hedges can trigger enormous, instantaneous flows of capital, completely overwhelming market liquidity. Even a tiny error in a hedging assumption can be the first tremor the shift stage. Then there's the rise of passive investing. Trillions of dollars now automatically track major indices like the S&P 500. This sounds stable, but during a crisis, it becomes a huge problem. Selling is no longer based on a company's performance. It's mechanical. If the index drops, these funds have to sell, creating a wave of selling pressure that amplifies the initial cracks. This is how a small shift turns into a fracture. Another critical weak point is our system's dependence on high-quality collateral, especially U.S. Treasuries. These aren't just safe assets. They are the lifeblood of modern finance, used for everything from securing loans to clearing derivatives. But collateral isn't static. Its value and usability depend on market confidence and liquidity. As we saw during the 2020 market turmoil, even the U.S. Treasury market, the deepest in the world, can seize up. When that happens, when participants can't trust the value of their collateral, the entire funding system becomes paralyzed. This is the moment a fracture begins to spiral into a full-blown cascade. Let's not forget how interconnected global funding markets are. Banks all over the world hold huge amounts of U.S. dollar liabilities to fund their operations. When stress appears, we often see it first in something called the FX basis spread, which reflects the cost for foreign institutions to get their hands on dollars. When these spreads widen, it's a classic signal that the shift stage has begun. The 2008 financial crisis and the 2020 pandemic crash both showed significant widening in these spreads long before the wider market panicked. If this stress isn't resolved, it cascades globally. Market structure itself has also changed dramatically. Today's liquidity is often described as thin but fast. High-frequency trading firms and algorithmic market makers provide constant quotes, but they're programmed to protect themselves. When volatility spikes beyond their model's comfort zones, they all pull back at the same time. This creates a liquidity cliff, a sudden, terrifying air pocket where buyers or sellers vanish. Once continuous liquidity is gone, price discovery breaks down and the cascade becomes almost inevitable. You can see this in public data from Treasury Trace and stock exchanges, where liquidity just disappears during stressful moments. Ironically, even the regulations designed to prevent another 2008 crisis can contribute to the problem. Rules like Basel III made banks safer by requiring them to hold more capital. But a side effect is that these banks are now less willing and able to act as market makers during times of stress. Their balance sheets are constrained. So when a shift stage imbalance appears, there's no one there to absorb the shock. Federal Reserve research points to this as a factor in both the 2014 Treasury flash rally and the 2020 market breakdown. The safeguards accidentally remove the shock absorbers. We also have to consider how large institutions are programmed to behave. Pension funds, insurance companies, and sovereign wealth funds operate under strict risk models. When market volatility spikes, these models can force them to sell assets automatically, all at the same time. This turns a normal market fluctuation into a crisis. We saw a perfect example of this during the 22 UK gilt market crisis. UK pension funds, using leverage strategies, were forced into a fire sale of government bonds when yields rose. What started as a shift in interest rates became a fracture, and then a cascade that nearly toppled their financial system, forcing the Bank of England to intervene. Central banks themselves are part of this story. Their policies, like quantitative tightening or QT, reduced the amount of reserves in the banking system. Federal Reserve data shows that even small changes in these reserves can create unexpected funding pressures. In 2019, the repo market, a critical short-term funding market, saw rates spike dramatically because of a scarcity of reserves. This happened without any major economic shock, proving just how sensitive the system is. It was a clear shift in liquidity that, luckily, didn't escalate into a fracture, but it was a serious warning shot. Finally, the way information spreads during a crisis is a massive accelerator. In today's hyper-connected world, bad news travels instantly. Price drops in one market trigger fear in another. News of a single institution in trouble, of margin calls, or of liquidity shortages causes a behavioral stampede. Research shows that during a crisis, correlations between different assets skyrocket. Everything starts moving together. Fear becomes a self-fulfilling prophecy, amplifying the real stress on the system and locking in the cascade. So, this three-stage sequence, shift, fracture, cascade, isn't a bug in the system, it's a feature. It's the natural result of a global financial architecture built on layers of leverage, collateral, and interconnectedness. Under normal conditions, this system is incredibly efficient. But under stress, these individual pillars of stability become collective sources of fragility. The shift is the first sign of imbalance. The fracture is when that stress hits an institutional or structural breaking point. And the cascade is the synchronized, defensive rush for the exits that follows. The good news is that we can see this coming. The warning signs aren't usually in the dramatic headlines. They're found by monitoring the subtle details: micro-level liquidity, funding market spreads, cross-asset correlations, dealer balance sheets, and collateral conditions. All the data is there in public reports from the Fed, the BIS, the IMF, and market exchanges. The key is to recognize the pattern, to see the quiet transformation of incentives happening just beneath the surface before it erupts into the next big crisis. The true lesson from every major financial collapse isn't that the system fails. It's that the system is designed to look stable on the surface while constantly shifting underneath. It's a structure built to hide its own fragility. Think of it like a three-stage trigger. The first stage is almost invisible. It happens quietly in the technical plumbing of the financial world. Small, seemingly forgettable changes start to occur, subtle shifts in funding costs, minor adjustments in collateral quality, changes in market depth that don't make the news. These are the earliest signals of danger, but they're never dramatic. They're just the system making tiny, almost silent adjustments to growing stress. Then comes the second stage. This is where the system becomes fragile, but it does so in the shadows. The small stresses from stage one begin to connect. Different parts of the market, which once seemed unrelated, start to move in sync. Leverage becomes more sensitive. Liquidity, the lifeblood of the market, starts to get a little thinner in key areas. Still, on the surface, everything might look calm. The stock market might even be hitting new highs. But underneath, the structure is becoming brittle, like glass with microscopic cracks spreading through it. The system can still function, but it has lost its resilience. The third and final stage is the one we all see, the public collapse. This is the moment the structure can no longer hide what's been happening. The cracks finally break the surface and the cascade begins. It feels sudden, dramatic, and chaotic. But it's not a failure of a single policy or a single bad decision. It's the inevitable release of all the stress that built up silently through stages 1 and 2. The crisis doesn't happen in stage 3. It's simply revealed in stage 3. By the time it hits the news, the game is already over. The dominoes were lined up long before the first one was visibly pushed. What makes this pattern so critical to understand right now is speed. The architecture of modern finance has accelerated everything. In the past, these imbalances might have taken years to build up. There were long lead times, slow-burning fuses. Today, thanks to high-frequency trading, complex derivatives, and globally interconnected funding networks, the entire three-stage process can unfold in a fraction of the time. The shift from stable to fragile can happen in days. The cascade itself can sweep across global markets in a matter of hours, faster than any human can react, faster than any institution can reposition, and certainly faster than any policymaker can even figure out what's going on. Every modern crisis feels sharper and faster than the one before it because the system S-tempo is tightening. This isn't a temporary bug. It's a permanent feature of the financial architecture we've built. The mechanism that links these stages remains the same, but it's operating on hyperspeed. So, if this pattern is so predictable, why don't more people see it coming? Because we're taught to watch the wrong things. We watch the news, we follow stock indices, we listen to experts debate economic data. But the real story isn't there. The people who anticipate crises aren't psychics, they're mechanics. They're trained to look under the hood. They watch how liquidity behaves when uncertainty rises. They monitor the obscure corners of credit markets that start to weaken even when the broader economy seems fine. They understand that the first signs of stress never appear where everyone is looking. The system hides its vulnerabilities in the background, in the boring technical details, because that's where the real machinery operates. The next crisis will follow this same logic, not because history repeats itself in the exact same way, but because the underlying structure that produces these events hasn't fundamentally changed. It's still a system built on leverage and interdependence, and that combination will always concentrate stress until it has to be released. So what can you do with this knowledge? The point isn't to predict the exact date or cause of the next crash. That's a fool's errand. The point is to change how you see the world. It's about learning to read the architecture of the system itself. Instead of waiting for headlines, you learn to watch the edges. Instead of looking for a single, dramatic catalyst, you observe the quiet, subtle adjustments that always come first. When you see markets move in ways that seem too small to matter, when you notice strange behavior in the plumbing of the financial system, you'll remember what a century of crises has taught us. By the time the problem is obvious to everyone, the system has already passed the point of no return. The real warning always comes earlier, spoken softly through the language of liquidity, collateral, and balance sheets. By understanding this three-stage trigger, you now have a perspective that few people ever get. You can see the part of the system that never explains itself, the hidden engine room beneath the polished deck. And once you see it, you can't unsee it. The architecture has always been there, quietly sending out signals long before the storm arrives. The next crisis, whatever form it takes, will begin the same way, quietly, almost politely, with a shift too small for headlines to notice. But this time, when that moment comes, you'll recognize it, because you now understand the hidden pattern beneath every collapse. Stay vigilant, stay curious, and keep watching the structure beneath the surface. That's where the truth always appears first.